Donald Trump is pressuring the Fed chairman to slash interest rates, and the market is not waiting around. It's already making its move. Today, I'm breaking down 6 stocks that can turn the coming chaos into an opportunity.
Good evening.
Back on January 11th of 2026, Jerome Powell dropped a bombshell, a statement accusing the Trump administration of blatant political pressure.
He should be sued for spending $4 billion to build a little building. I'd love to fire his ass.
To put it bluntly, Trump wants 1% rate, but Powell is holding the line.
The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president.
That Sunday, headlines worldwide were in shock. I was buried in finance Twitter, reading every take, every thread until midnight. Because if panic was coming on Monday, I wanted to see it first. But the following day, I was shocked to find out prices barely moved. That silence was the loudest signal I've seen in years. It meant investors were already pricing in a lower rate outcome despite Powell's public resistance. That's when the real question stopped being, will rates fall? And became, how do I prepare myself for what comes next? In this video, I'm going to show you exactly how. We're breaking down 6 stocks across key sectors, plus one wildcard the market isn't talking about yet. It's time to prepare for the uncertainty ahead. When rates eventually drop, where do you think the impact will be felt most? It's not tech, it's not oil, it's housing. And if you want to play that rebound, you should definitely look at the largest supplier of structural building products in the United States. We're talking lumber, windows, roof trusses, and other structural components. Builders First Source. Interestingly, nearly 70% of their business is tied directly to residential construction. The moment those interest payments shrink, homebuyers flood back in the market and construction restarts, creating demand for their products. There are 2 specific reasons this company stands out in a crowded sector. The first is their high operating leverage. That might sound complicated, but it's actually very simple. Builders First Source has massive fixed costs, things like warehouses, truck fleet, lumber yards, all panel plants. They have to pay for these whether demand is high or low. But once those costs are covered, every single extra sale flows almost entirely to their bottom line. Roughly a 10% increase in housing activity can translate into a 30 to 40% jump in their earnings. The second reason is, since 2021, Builders First Source has been aggressively buying back its own stock, retiring nearly half of them. But why does this matter? Well, during slow periods, shrinking share supply creates less selling pressure, helping put a floor under the stock. While in a housing rebound, it boosts the earnings per share even further. Now, I can feel some of you doing the math in your head, wondering if it is too early or if the Fed waits an extra 6 months. If that's you, you're missing the point. These picks aren't about guessing the exact rate cut or timing it. Think of it this way. You don't have to guess the exact millisecond to let go of the bowling ball. You just need to know that it's rolling toward the pins. That's why, instead of trading short-term moves, we're using long-dated options, specifically long-term equity anticipation securities, or LEAPs. This gives the rate cycle time to play out, while keeping capital requirements lower than owning the stock outright. Each of the stocks coming up on this list benefit from falling rates in different ways, but the trade structure stays the same, because in this game, time does the work. Now, if lower rates restart housing, the recovery does not stop at homes. It flows straight into logistics real estate, which leads us to the next stock on our list. Prologis is the landlord to GlobalCom. They own over 1.3 billion square feet of logistics space across 20 countries, and it's estimated that roughly 3% of global GDP flows through their buildings. For them, lower rates matter in 2 ways. First, this is a long-duration asset. When rates fall, the value of decades of rent payments rises sharply. Second, cheaper rates reduce refinancing costs, directly improving cash flow. Because they are a real estate investment trust and are traded like bonds, repricing doesn't happen overnight. It unfolds gradually as rate expectations reset. That's what makes long-dated calls effective here. You're giving valuation the expansion time to play out. But the fastest-growing infrastructure isn't physical at all. It's digital. With Equinix, we are effectively transitioning from industrial real estate to digital real estate. Its customers include Google, Amazon, the big banks, and cloud providers, all interconnected inside Equinix data center. With over 460,000 interconnects, if you want the lowest latency access to the cloud, you have to be inside their ecosystem. Even competitors collocate here, creating a network effect that's extremely difficult to replicate. Like Prologis, Equinix is a long-duration asset. Lower rates dramatically increase the value of its future cash flow and reduce the cost of building new facilities. But Equinix also has an edge in AI. They're investing in advanced data centers and liquid cooling to support rising compute demand. This gives you AI exposure without paying peak hype valuations or volatility. Infrastructure companies are awesome. They enable this cycle. But this next company extracts the value from it. Amazon's a multi-layered giant. It can capture the benefit of rate cuts at least across 3 sectors: cloud, retail, advertising. For them, lower rates support consumer spending and increase corporate demand for long-term cloud services. But the real leverage is capital. Amazon plans to spend over $125 billion on debt-funded AI infrastructure, and falling rates make that investment dramatically more profitable. Interestingly, the market increasingly prices Amazon Web Service like a mature utility, even as AI demand is still accelerating. Therefore, a long-dated, deep-in-the-money calls allow exposure to that upside with far less capital than owning shares outright. If NVIDIA builds the brains of AI, Vertiv keeps them alive. Vertiv supplies the critical infrastructure behind AI systems, from uninterruptible power to advanced liquid cooling. When these systems fail, everything stops. This business is deeply tied to capital spending. Cheaper capital lowers financing costs and accelerates multi-billion-dollar infrastructure projects like the $9.5 billion backlog they already have. Just like Builder's first source, Vertiv has a high operating leverage. Now, once fixed costs are covered, incremental revenue rapidly flows to their bottom line. As AI build-out scale, their margins expand quickly. That's why long-dated calls make sense here, giving the build-out time to unfold without requiring perfect timing. Though hardware responds well to cheaper capital, software companies like the next one is where falling rates do the most valuation work. Palantir is a software asset that has successfully transitioned from a secret government contractor to a major commercial AI platform that lets companies deploy large language models directly on their own data and workflows. Lower rates matter here because they increase tolerance for future earnings and unfreeze enterprise software budgets. That's when long-term platforms like Palantir get adopted. My final bonus selection is the smallest on the list, but it's the one with the most explosive potential. LendingTree is basically a lead generation machine for the banking industry. They don't lend money themselves. Instead, they connect borrowers with over 500 financial institutions. As rates fall, millions of homeowners who took out high-interest mortgages between 2023 to 2024 will rush to escape their 8% mortgages. Because it's a sub-$1 billion company, it doesn't take much rate cut or incremental demand to move the stock meaningfully. So that's the setup. Long-dated calls to give the macro story time to show up in reported results. If you want more breakdowns like this, smash that subscribe button. I'll see you in the next one.